This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty joining in right at the top of the hour. It's 8 p.m. Eastern Time, and I'd like to welcome all of you to our open house Q&A, especially the new folks who have been tracking the Market Guys week after week through our weekly market report. If you are new to the open house Q&A, I'd like to just give you a little briefing on the format. What I do first is I go over the major markets, and then I go into some strategy discussion. And then after that, I open up the floor to questions and or stock analysis where you could submit your stock symbols, and we'll go through a rapid-fire session of stock analysis. Now, with that said, please don't submit your stock symbols until I ask for those, because we have a scrolling Q&A window right there. So if you put them in too early, and then questions come up, the questions will push your stock symbols off to the side and I won't see them. So that's the little bit of housekeeping there. The markets have been in what I would say rational, exuberant mode. I mentioned that on one of our weekly reports, where if you remember way back before the crash of 2000, Fed Chairman Alan Greenspan described the markets as being irrationally exuberant, where the markets were overreacting to the upside. There was a bubble. He was forecasting a bubble. He was right when the bubble popped. So what I did is I just changed up that exuberance phrase and talk about rational exuberance. Now, the rational part is that we are seeing a new revived optimism in the market, with President-elect Donald Trump coming in with his campaign promises to be the greatest jobs president in the history of the USA. We'll have to see if that is actually a fact that will come to fruition. But the investor community believes that that will happen. Now, so that's the rational part. There is a rational reason for the new money coming in, and hence we see that since November 8th back here, this is actually the day of the election, the markets crossed over the 20-period moving average, and we've gone into a significant upward leg. Now, this is the spiders. It's the S&P 500 ETF. We can go to every chart, and you'll see the same up leg or upswing where we have the new money coming into the market. What I'd like to do is talk about the reality of what is out there with regard to the global economy, particularly U.S. debt. And it doesn't matter what political flag you fly. I think we all know that as optimistic as Donald Trump and his supporters are, there is no way we're going to be able to eliminate the massive debt that we've taken on as a nation. If you look at the quantitative easing, 1, 2, 3, and others that the Fed had contributed to with regard to printing money to stimulate the economy, there is a lot of money being spent. And even if Donald Trump stays in there for 8 years, he's not going to be able to reverse that. Even with the spending cuts that he's talking about with the EPA and some other parts of our government, there's still not going to be enough cuts to offset the debt. That's number one. Number two, the good news is that if he does turn out to be one of the greatest jobs presidents ever in history, we're going to see an increase in the GDP, the gross domestic product, which could very well stimulate the Fed to hike rates. Now think about this for a second. What happens when the Federal Reserve starts hiking rates on a consistent basis? Who would like to answer that first? What usually happens when the Fed raises interest rates to the market in particular, and even the bond market? What do we usually see? There's a little bit of a delay there. I'll tell you, when interest rates go up, the general markets tend to go down. The bond market is inversely related to interest rates, so we'll see a drop in the bond market as well. There are a lot of baby boomers out there that are diversified, particularly in the bond market, where if we see a drop in bonds, although they're locked into interest rates, we might see people moving out of bonds, and then we could see money moving into other areas, and we'll have to wait and see when that actually happens. But again, the reality is we're not going to get rid of our debt. There could very well be a stimulus through job creation, and as a result of a stronger economy, the Fed might feel better about raising rates to make the dollar more attractive. Now, with all that said, when you put that into the pot and mix that around a bit, you're going to see that there's probably going to be some added volatility in the markets as well. This is the spiders, but if I take a look at a monthly chart, look at this. This is a 20-year monthly chart of the S&P 500. You can see that from 2008, 2009, this, without question, has been the greatest bull market that I've seen in my lifetime. Yet there is very little evidence of any kind of correction in the market. So if I take this low, connect it to this low, and project out to this low and move forward, there's your upward trend line right there. Any kind of a break in this trend line, and it wouldn't really take much for the markets to move down below that trend line, any kind of downward pressure below that line could spark not just investor selling, but you could also see institutional selling as well. With that said, you have stop loss orders that are built into the market below key support levels. And if you're not familiar with what a stop loss order is, these are orders that are placed in with the brokers that will fire off and enter market sell orders when the markets reach key support levels and actually go below those support levels. So there are many, many investors and institutional traders who are trailing their stops up this line. So when you have combined selling from an institutional level and a private level into this sell stop area, that's going to accelerate the sell and the selling pressure, and it could create the correction that we're looking for. How far down can the S&P go? Well, you can look for at least a 50% retracement. That's being conservative. So if you have the S&P, the spiders here, trading at 225, there's no reason why this can't get to 155. Percentage-wise, that's a big hit, yes. It doesn't mean that the markets are completely collapsing and the world is coming to an end. That would be an honest correction. Now, finally, the Fed, in my opinion, will not really take any hard action with interest rates until after Donald Trump is sworn in on January 20th. I believe that, and it doesn't matter what you're seeing in the newspapers, I believe that the Fed is politically driven. And again, President Obama has, to his legacy, I believe the greatest contribution that he could pass in his legacy in the story is that he does have the greatest bull market of any president for a prolonged period of time. Since the very beginning, when he first came in, the markets had that collapse, the bubble, the real estate and everything else popped here. If you can see my cursor back here, back in 2008. But there were telltale signs before the market crashed that led us to believe that this correction would actually happen. The crash of 2008 was a 105% drop from the beginning of the bull market back here from 2002 to 2008. That was a 6-year upward trend. So this market in 2008 gave back more in 1 year than the market had gained over a 6-year period from 2002 to 2008. So again, being very conservative, a 50% pullback is not something that's outrageous. And again, the reason I point this out to everyone is because, again, you have to be very careful of being too optimistic with the news. You have to be a very cautious buyer if you're going to take any long positions. And you have to make sure that you're going to be sticking to a good discipline with regard to risk management. I'll get into that in a little bit later. But you have to be using good, strong risk management principles so that you're not taking a catastrophic hit at all. You only want to subject yourself to a 1% loss on any trade that you make. And again, I'll get into that in a little bit. Now, if we look at the diamonds, again, this is a 20-year monthly chart. You can see that the acceleration here in this upward leg from here to from this low to this high is quite dramatic. And if you look back at the upward legs that we've had in any length and period of time, we have from that low to that high, from this low to this high. You could see that these angles, although these were steep inclines for the upward trends, this angle is a little bit more severe than what we've had in the past. So again, you have to keep an eye not just on your daily charts, but look at the monthly charts as well. Right now we have a good strong green monthly candle here, but look at the volume. Underneath, the volume is dropping. As I zoom in and look at the weekly chart, you'll see that line will stay in place. We're seeing some telltale signs of a possible top on the weekly chart. Can anyone tell me what this candle is right there? This long shadow with the little body underneath that. What's that called? Who are the technicians out there that will give me an answer? Oh, it's not quite a doji. That's an inverted hammer. A doji would have no color to it at all. It would have no body. It would look just like a cross, but that is an inverted hammer right there. So this is what we have to look for on the weekly chart. Now, if I zoom in on the daily chart, right there, you'll see that the volume, once again, over the past 4 days, has been a dramatic drop in volume. You see that? Today's volume was roughly 40% of what it was just last Wednesday. 40% of what that was. So that's telling us that the buyers are starting to lose some of that momentum. And on Friday, we had a bearish engulfing pattern right there. We cannot ignore bearish engulfing patterns right there. So, so a question comes from David, and David, I saw your other question as well, so I'm going to work that into the risk management part as well. But David's question is, so we all know that there will be a downturn at some point. How should we take advantage of the rational exuberance uptrend that has developed to date? Well, the advantage or taking the opportunity is when you're looking at the volume increase on the way up. And option traders could either sell put spreads, they can go long. Equity traders can just go long their stocks, but again, keeping their stops very close underneath support levels and moving ahead that way. Right now, the rational exuberance that I'm talking about is starting to wane down. You see again, that volume, especially on the Dow, tells us that there's a lack of excitement, a lack of commitment on the upside, and that's why I continue. These lines were drawn actually a week and a half ago. I am keeping those lines in place because I do think that the markets will pull back. So that's how now you take advantage of any profits that you might have on the table. I tell people when the signals start getting negative, the answer is always in the charts. You have to say to yourself, well, if I have a long position, what are the charts telling me to do right now? And a better question is, if I didn't have a position at all, what would I be doing? Would I be taking a long position on a bearish engulfing pattern, or would I be taking a long position with long shadows above these candles right here? The answer is no. So if you didn't have a position, and the answer would be no, I'm not going to take a long position, then you have to manage the long positions that you currently have. When I see long shadows above the candle or bearish indications, I'm at least taking half the profits off the table and trailing the stop on the other half. That's the way you manage an up market that is starting to slow down in the upward trend. Okay, so that's the diamonds. Let's look at the Qs. ticker symbol QQQ. See right here, let me move my Q&A box out of the way so I can get to the zoom in button. This was my forecast from last Friday. I thought that we would start to pull back. We're pretty much in line even on Monday with the body, half of that body actually on the line already. But I do see that the volume is starting to slow down here as well. And when the price is going up and the volume is going down, again, that's a signal that the buyers are getting tired. That's number one. Number two, we always need to pay close attention to the divergence between this blue line, which is the 20-period moving average, and the price of the stock. Again, for those who are new to the Market Guys, all you have to do is go to the Market Guys website. I have it right here. Click on the video tab, and there is a video that talks about the rubber band effect. It's the second row down on the right. Watch that 7-minute video, and it'll explain to you exactly what the rubber band effect means. You could see that if the blue line, let's call that the fair value of the NASDAQ market. I'm just using that as an analogy here. Let's say the blue line is the fair value for the market, and all of a sudden there's news that comes out that causes buyers to come in whatever knee-jerk reaction that is, and prices are driven well above fair value, you could expect that prices will eventually drift back to that fair value. That's exactly how option traders trade, on the professionals that is. They trade options based on what their fair value calculation is. If they're called to make a market in any particular option contract, they have these little sheets that they carry around with them, and many have computers that will give them the fair value for an option. If someone says, what's your sell price for that particular option, they're going to put an ask price that's higher than the fair value. If someone comes to them and says, okay, what's your buy price for that option, they're going to bid below what that fair value line is. And then they will hedge themselves, and when the option comes back to fair value, they unwind the position. Equity traders can do the same thing. When a price is trading dramatically above what we're calling here now as fair value, you want to be more of a seller, not so much a buyer. When the prices are down well below that fair value, again, and the rubber band is being stretched, you want to be a buyer on any kind of buy signal, or like in this case, a spinning top, or maybe even a hammer, or a spinning top here as well. You want to be a buyer when the market's being stretched below. And then when it comes back to fair value, you're unwinding that position. Okay, so that's the Qs. I still think the Qs are going to pull back to the 20-period moving average, so be very careful of any new long positions. Now, if we look at the, let's see, we did the Russell 2000. Okay, we did the diamonds, we did the Qs, and we did the spiders. Okay, now what I want to do is I want to look at the VIX. The VIX, and I'm going to have to back up a little bit because this is pretty incredible. The VIX is an indication of volatility readings for the S&P 500. This is a 20-year chart of the VIX. And if I turn this into price level, you could see here that if I just pick that low right there, I could capture a common support level for a lot of this market from 2005, 2007. And you can see all the way to the right, 2013, 14, 15, 16, and coming into 17, the market, the VIX, is hugging that support level. Now, whenever you have a market, the VIX that is, that's hovering around 20-year support, that generally indicates that we're reaching a market top. And that is the leading indicator that many professionals use to gauge their own positions. So when you see the VIX is on 20-year lows, again, you're not going to be an aggressive buyer. You're going to be positioning yourself and even hedging yourself for a downturn in the market. And that's how we use the VIX. If I go back to the daily chart, There we go. You'll see that we're down below that 20-period moving average, but my forecast for the VIX is that we're going to start to move up over that moving average, which in turn will start to push the S&P and other markets away to the downside. Okay, so we covered the markets, and now I want to talk a little bit about the risk management. And this goes to David's question that I deferred earlier, and I'm going to read this for you. Could you elaborate on your risk management philosophy for option spreads? For example, do you advocate exiting or adjusting a vertical spread when the short call is threatened or reached? And do you express that in your option oracle? I'm going to answer the last question first. Yes, I do address that in the option oracle. I put all my risk notes in on the bottom of the last page in the RM note field. That's the risk management notes. Now, although I'm addressing an option question, I want all of the equity traders to pay close attention as well as I review the 1% rule for managing risk. Again, going to the Market Guys website, you'll see third row down on the left is the 1% rule. And you can review that on the video, but what I thought I'd do tonight is I'm going to bring up a little bit of a Word document so you can see how the 1% rule actually works. The 1% rule, if I were to put this into a statement, basically states that on any trade that I do not want to subject myself to more than 1% loss of my. Now that 1% is my account value. So the risk amount, the amount that I'm willing to risk, is going to be 1% of my total account value. So in this case, if I'm using, as an example, I'm using a $100,000 account, what's 1% of that? That's going to be $1,000. So this $1,000 becomes my risk amount. In other words, whether I'm trading equities or if I'm trading options, I do not want to be losing more than 1% of my account on any trade. So let's keep going with this. The risk amount is the first part of the calculation. The risk per share is what I am risking per option trade or per whatever equity trade that I'm using. So let's say I'm doing a credit spread. Let's say I'm selling a credit spread and it's a $10 credit spread. I collect $1 in this. Again, equity traders, bear with me here. But my maximum loss, let's see if the option traders know this. If I am risking, if I'm selling a $5 credit spread and I get paid $1 for that credit spread, what is my maximum loss? Again, equity traders, stay with me as we address the option question here. So in other words, if I have a $5 wide spread and I collect $1, what's the most that I could lose on that? So Philip came up first, and that is going to be $4. So if I have a credit spread and my maximum loss potential is $4, then I take my $4 and I divide that into my $1,000 risk amount. Now in options you have to trade whole numbers. So in this case, if I was an equity trader, I could buy 250 shares. But in an option trade, I'm not going to do more than 2 or 3 option spreads, because then the most I could lose is roughly $1,000 if I'm completely wrong. Now JNUG, we actually had a loss on that one where we took a $1 loss on that. Actually, I think it was a $2 loss. So in that case, if you're doing a vertical spread, the risk per share would be $2, and then you can't trade more than 5 option contracts against that if you're using the 1% rule. So hopefully that helped answer your question, David. And yes, so in the future trades that we put out, especially with spreads, look at the risk management note field, and you'll see that I calculate what the maximum amount of risk is, and therefore I try not to mess around getting in and out of the spreads if the short call is threatened or even reached. I know what my maximum loss is going to be. It's pre-calculated, and if I take that loss, then what I do is I move on to another trade, and I use those trades to make back the loss that was incurred in the previous trade. So if 80% of your trades are making money, then you shouldn't have any problem making back the losses that occur every 20% or 25% of the time. Okay, now let's see. I am going to take some stock symbols right here. And let me see, David, one more thing, and then I'm going to have to move on to the next question. But if you manage the trade appropriately, can you not enter a trade when the maximum loss is greater than 1%? I would not do that unless you are, if you want to expose yourself to, let's say, a 2% loss max, then you just gauge yourself that way. You can just take, instead of $1,000 here, if you want to do 2% instead, and take $2,000 as your risk amount and do the same calculation. So if you take $2,000 and you're risking $4 per share, then you can do 5 contracts on that, and that's what you would maximize, or I should say limit the size of the position from there. Okay, here we go. We're about halfway through already, and we're going to take Sean as ARRY, and Sean did a good thing. Sean told me what his position is, so if you're going to submit a stock symbol, please submit to me also what your intention is, whether you already have the position, or if you're thinking about an entry position, or if you're looking for an exit strategy. We'll let the charts determine what that might be. So let's go to ARRY on the daily chart. ARRY, and right now I see that this is a stock, again, this is a stock that has gone almost vertical. Okay, you shorted this. Now that's a good thing, because Sean has actually taken a short position on this one. If you look at this, you see a support level down here right around 5, I guess that's around 540. Now let me get my drawing tools out here. If I go and take this low and bring it to this high, you can see the angle is pretty steep. You could also look back at the past and see that these angles would apply to previous up legs as well, and that's pretty close to what we're seeing right now. But notice what's happening with the size of the candle, and also notice what's happening to the volume. The volume is virtually nil here. And that's a big flag, because if you look right here on this particular one, let me see, what's the volume? The volume on that is 6,246,000, which yeah, that's not so bad. I mean, you want to see at least 500,000 on the very low end. So you have 6,246,000 shares traded right there. But if you look more closely, you'll see that the volume is still a lot less than what it was back in September. You see that? Where we have big spikes in volume. So that's number one. We have very small volume when you compare it to historic volume. Number two, look at these candles. We're starting to see, we have a bearish engulfing pattern last week. We have long shadows above the market right here, which indicate to me that the buyers tried hard to break it over resistance up here, but they failed to do that. Okay, number three, today's volume is just a little bit more than half of what it was on Friday. So, Sean, if you're short and you shorted this at 880, you're already in the money by what? Just 9 cents. But there's a good chance that this stock is going to start to come down. Now, Sean, if I may, if you could just help me with this. You shorted the stock, so you want the market to go down. What is, where is your buy stop? Where did you put your exit strategy? and how much are you risking per share on that one? Let's take a look and see if Sean could answer. I know there's a little bit of a lag there. Okay, so your target is $8, but where's your stop? I mean, $8 is I think it's a reasonable price, but there's going to be some support between your target and where you short it. Okay, so your stop is over 907. All right, let's see. That high is $9. Okay, right here is $9 from today. Your stop is 907. Okay, so you have a 27-cent risk per share. So what I'm doing for Sean is using him as an example as well. If he's risking 27 cents per share, he'll take that 27 cents and divide that into his risk amount to determine how many shares he'll get to short. And Sean, I don't need to know how many shares you did, because then we'll know how much money you have in your account. But my point is, you use that risk per share to gauge your risk and the amount of shares that you're actually going to trade. So let me just show you this, Sean. There is going to be a role reversal support level right here. You see that? And that's why I drew my line right to that end right there, because this former resistance was broken here, and then it immediately turned into support. So this support level right around $8.26 could very well get in the way of you making your profit and closing the position at 8. You see, what could very well happen is this stock is going to bounce off of support and do that. So the best thing for you to do is, once the stock starts dropping below the 20-period moving average, you're then going to move your buy stop from 907 to just over 838. So you, at that point, let's say you have a buy stop at 840. Again, that buy stop would only be if it drops below the 20-period moving average. You're then going to now protect your profits and trail your stop down. So that's how you treat this position. You're looking for a down move by being short, but you don't want to just ride it and hope that it goes down. You have to look at the signals, and so far the signals are looking short-term bearish for you right there. Okay, let's go back to some of the other positions. Let's see. After Sean came, let's see where. Okay, Rick Wilson. Rick is looking at BSX and SWHC. Rick, I may only have time to take one, but let's see. It says I filled lower gaps and I doubled up on long positions. All right, let's see BSX first. All right, so you have a long position and you've doubled up on this. All right, now the good news is that the stock has broken out over resistance. They have a breakout here, which happens to be the 20-period moving average. So BSX. Now, Rick, I don't know what your long position is. But again, assuming you took a long position somewhere lower, the gap has filled. Right here, there's a small gap. And you are right at a resistance area as the candles are getting smaller and as the volume has now dropped today. The volume is probably 15% lower than what it was on Friday. So if you have a position on this, it would not be out of the question for you to take a profit, because you're in profit zone, but you're at resistance, the volume is dropping, the gap is filled, and the stock does not like to be this far above that moving average. Again, look at historic prices. When the price moves this far above or diverges from that moving average to the upside, it does not like to stay that far. And this, you can see that now that rubber band is being stretched, so there's a good chance that this stock is going to pull back to that moving average before bouncing and going higher. And there is a good chance that it could bounce, but only time will tell with that, when you have to actually wait and see if the bounce actually occurs. So hopefully that helps you there. Now, I will go with Smith & Wesson, SWHC, because this is a position that many hold. And This is one that is moving up back to that 20 period moving average, and there are gaps above the market. Smith & Wesson will be filled that gap at 23, and this gap would be filled up there around 27.90. So I would not expect the second gap to be filling so quickly, but there is a very, very good possibility that this stock could fill this gap. Therefore, once the gap fills, there's an 80% chance that the stock will pull back from that point. So what I would do on that one, Rick, is as soon as it gets over the 20 period moving average, I would move your stop up with that one as well, with a target price right around 23 to completely get out and take your profit on that one. Okay? Now, let's see. Dana says, what do you think about NUGT and SLV? These are the precious metals markets that we're talking about right now. NUGT is now gapped down. Last Thursday, it gapped down, and we have a series of gaps here. Now, NUGT has a gap right here. It has another gap unfilled up here. It has another gap unfilled up here. And it has another gap unfilled right here. Now, NUGT is a leveraged instrument for the gold miner index. Now, what does that mean? If the gold miner stocks go up, let's say 5%, these will go up 3 times more than that. So if the gold market goes up 5%, these will go up 15%. And that sounds great when you're right, but you have to watch out, because on the downside, it could move 3 times that much more against you, so you have to manage the risk as well. The good thing about NUGT is that it's being so cheap, you could, especially for the option traders, I mean, if you bought this at $5, $6, you can most likely find an option trade to pay for that entirely. And even if this thing went to 0, you could use the option trade to pay for this particular position. I call that the free stock plan. In fact, maybe in the next alert for the option traders, I'll talk more about that. And now, so I'm bullish on NUGT for that reason. The rubber band's being stretched. The volume is dropping on the way down. We have stale red lights with overdue for a green. And SLV, I made this very public. I am in the accumulation phase of SLV, not just in SLV, but I buy physical silver. My wife and I both, we physically buy silver. And our reason for accumulating silver is because it's trading well below the cost of what it costs the miners to pull it out of the ground. So it's below mining costs. It's below production costs. So I feel very, very comfortable. Yeah, let's face it, if you own silver and it goes to 13, you're not going to feel good on your existing position. But what you should be feeling good about is you get to buy more shares. So for a long-term portfolio, SLV is a great one to accumulate because it's all about the number of shares or the number of ounces you control, not so much about the immediate profits that you're going to make. Now with SLV, again, look at the rubber band. I'll zoom in here for you so you can see. SLV does not like to stay this far below the moving average. See, if I take that and measure against this, you can see this is a long stretch right here. You can see back here is a fairly long stretch, and even back now, below that moving average is a fairly long stretch. So what's my forecast for silver? I think conservatively we can go back up to 1576, which is that moving average, maybe pull back a little bit before going higher and breaking out to a new high level. That is a very reasonable expectation because if you look at the past, that's exactly what this stock has done over and over and over again. So again, if you're going to take a new SLV position, use the 1% rule to gauge your risk, calculate the percent of your total account value is, divide that by the risk per share, which is the price of the stock minus your stop price, divide the risk per share into the risk amount, and that tells you exactly how many shares that you get to buy. So hopefully that helped you, Dana, right there. And let's see, Antonio, I'm starting to run out of breath here. You guys are keeping me pretty busy. ABX. ABX was down again today. Same thing for ABX. ABX is one of the most widely held gold stocks by institutions. Now this has been in a downward trading channel. Let me show you how a channel looks. If I take this high, connect it to this high, and project out, that's going to be my downtrend line. If I take this line and I mark it on the opposite side by running it parallel to the trend line, there's my trading channel. Now this is right in the middle of the trading channel. My short-term target is up because you have a gap here, and I think this could very well, you can see what my forecast is, it could very easily go back up to the 20-period moving average, and if it breaks over the moving average, what you would most likely expect from there is a rally to the trend line and then a possible turn lower. So this is one of those stocks that you can actually trade, technically that is, even if it's in a downward trend. You could still trade it within the day, as you can see where the pivot points are most likely going to show up. Now, let me just take it one step further, Antonio. If this stock breaks out over that downward trend, you would most likely see a dramatic move higher from there as the optimism comes back into the gold markets. And again, this is most likely going to work inversely to interest rates. So there's an old saying, you don't fight the Fed. Yeah, have you heard that before? You don't fight the Fed. In the up bull market that we've had during the Obama administration, they were doing quantitative easing till we got sick of hearing about it, but you would not have, or you would have lost money had you fought the Fed. But when the Fed keeps interest rates low and the markets keep going higher, you don't want to buck that. Now that the Fed is starting to hike rates, you now want to go with the Fed again. So ABX, GLD, IAW, Silver, SLV, Silver Wheaton, any of those stocks, NUGT, JNUG, those are all stocks that would work directly in line with interest rates, and that's what you want to do. You don't want to fight the Fed, you want to go along with the Fed. Okay, Antonio, I didn't see, all right, so you want to buy it. Okay, well, I would wait for the next green candle if you haven't bought it already. This is a slight red candle, but the good news is the volume is almost half of what it was on Friday with a very small spinning top. That's usually a good sign. So if you do decide to buy it, make sure you put your stop. I would put a trailing stop maybe $1 below where you buy it, so you have a risk per share of $1 to use in your calculation. All right, Larry says, SIG option spread, sell the 105. Let me see. Okay, so you want to sell the 105 and buy the 155 call? Let me see, Larry. Let me first pull the stock up, SIG. Let me see, SIG. Cygnus Jewel. All right, so you want to sell the 105. So Larry wants to do a credit call spread on SIG and buy the 155s. Oh, 115s. Okay, so you want to sell the 105s, buy the 115s. Well, Larry, I don't know if that would be a good idea, because when you're selling a call spread, that's a bearish strategy. If you're selling a credit call spread, you want the stock to go down, not up. See, now the stock is going up, and not only is it going up, but you have a sign of a possible bounce off of this 20-period moving average. This stock could actually start going up. You see 1, 2, 3, 4, 5 red candles in a row, which is known as a stale red light, was followed today by a green candle. That's the buyers starting to move in. And the dramatic drop in volume down at the bottom there tells us, see that volume drop? That tells us that the sellers are virtually non-existent today. It was only the buyers that started to creep in. So if you're thinking about selling a call spread just prior to the market going up, I would say that's not a good idea, because remember what I said, the answer is in the charts. You have to look at this as though you don't have any position, and you say to yourself, okay, looking at the charts right now, would I be a buyer or would I be a seller? Well, if the answer is I would be a buyer, then obviously you don't want to do anything that's bearish or sell it. So I would wait until the stock reaches some sort of resistance area before even considering selling a credit spread that would be that bearish position. So this is one of those cases where you want to be patient. Okay, and let's see. Hendra wants me to look at is it Agilent? Hendra, if you could please let me know what your idea is behind these stock symbols. All right, it helps me help you better. Right now, I don't see too much bullish activity going on with Agilent Technologies. In fact, if you look, this is in a downward trading channel right here. You see this? There's your downward trading channel, and this has been showing a regular rhythm, almost like an EKG, where the stock goes up to that downward trend line and then pulls back. This is pretty regular. So looking at this one, I mean, the only positive thing that I see is a drop in volume here, but there's still bearish engulfing pattern on Friday, followed by a long stretch candle there, and that gap is filled. But there's a good chance this stock is going to follow suit, just like it did in the past. So if you're thinking about buying Agilent here, I would wait to see if in fact it starts bouncing off of the channel line, which is going to be somewhere around 42. That's the next best place to be buying it. Or if you want to take a chance and see if it bounces off of that 20-period moving average, you could do that. But I still think there's too much downside exposure to be taking a comfortable long position. So again, that decision's up to you. But if you do decide to buy it, you're going to have to keep a pretty tight stop-loss order. Now, as far as XBI, similar position here because you got the stock down below the 20-period moving average, which is now acting as resistance. You have long shadows above the candle, and it looks as though there's still some unfilled gaps below the market. So here's a gap down here right around 58.5. Here's another gap around 55.5. There's a good chance that those gaps will fill first before going higher. So again, put your price alerts down here at the gaps, and if you see a bounce off of that gap fill point, that could be an entry point with a stop right below that line. Second entry point would be a bounce off this gap fill area with a stop maybe right below that gap fill point or maybe even lower below the lows from back here in October. All right, so hopefully that helps you out. All right, now Ken is looking at MDT. Is that Medtronics? I'm getting a little rusty with my stock symbols, but I think that might be Medtronic. Yeah, it is. Okay. Medtronic, and let me read what Ken is talking about. MDT call spread at 75, selling front week calls to January 20th, 2017. All right. Now, if you are looking to sell the 75 calls, understand that you'd be obligated to sell the stock at 75. There's still a gap up here. Now, the dangerous thing about selling a 75 call in a stock like this is that it's taken a significant hit just from November. I mean, this stock has dropped almost 15 points in a matter of weeks, and that's a huge hit. So it's going to be very hard for the stock to get back up because all of the people, it looks like they capitulated back here when you had this big gap. So it's going to take a little while for the investors to gain confidence again, for it to get back all the way up to 80.5 to fill that gap. Now, let me give you a little tip on gap trading. Gaps, of course, the rule is, and this is 34 years of experience, 80% of gaps fill. That's a fact. Rule number 2, 80% of the time after a gap fills, the market will reverse and go the other way. here's a good example. Here's a very minor gap right here. It filled on this day, and then 80% of the time it will reverse. It will go the other way, and that's exactly what happened. You see, now the other rule is that small gaps will generally fill more quickly than the large gaps. Large gaps are usually driven by severe or significant news that shakes up the market, and it takes a while for those investors to get back in because the news was so significant. So you could see why, you know, a small gap is quicker to fill than a large gap, because these people have lost money. They're not going to jump right back into the fire. See, if I zoom in back here, you'll see the second rule that I was talking about with regard to gap fill points. Here's a stock here, the stock gap down. It went from a high of 78.25 to a low of 73.06. This is a big gap, right? Here's the gap. Once the gap filled on this day, what did it do? 80% chance of doing what? Reversing. And it did that. It went the other way. Same thing over and over again. Here's a small little gap right there that was filled on this day. Once the gap was filled, it went back, it went down again. So you can count on these gaps to reverse 80% of the time, but 80% is not 100%. So you have to be very, very careful that you manage your risk accordingly, because a lot of people, what they'll do is they'll wait for a gap to fill, and then they take a position betting on the opposite reversal. And if you do that, you have to, again, understand that you're going to be wrong 20% of the time, so you have to protect yourself. All right. Darius has the question on OIH. Now, the option traders bought puts a while back on OIH. I do believe, I don't have my spreadsheet up, but I do believe that we bought the January 35 puts. I think we bought those for around 5 or 520. Let's see. I got to find my spreadsheet. All right, these are the January 35 puts. Now, they're down about 25 cents, 30 cents from where we bought them. Now, the strategy on this is for the stock to come down. Now, the stock, interestingly enough, the stock has come down, especially over the past week. It's dropped pretty significantly. But look at this, folks. Look at the gap down today. So remember, that gap eventually I think will fill, but that's good for us, the option traders. The stock gap down today, but look at that volume. All right, now here's a test question coming up. If we have a red candle and it's gapping down on higher volume, what does that tell you about the motivation level of the sellers? Who wants to answer that? Well, oh, wow, Greg, you're quick. Yes. If you see an increase in volume on a red candle, it means the sellers are motivated. So what does that mean? We're expecting this stock to drop even further. I think there's a good chance this stock could drop to the 20-period moving average. We're not that far away from it. And if it does get down to the 20-period moving average and shows any sign of bullish reversal or any kind of drop in volume at that point, then what we're going to do is we're going to sell the at-the-money calls, at-the-money puts, and turn that into a diagonal spread. So what's going to happen eventually is we're going to take in cash to pay down the cost basis of the leap. Now, those equity traders that don't know options just got a whole bunch confused right there. But for the option traders, keep your eye on your alerts, because we're going to talk about that when the stock, I'm monitoring this very, very closely. So if it gets down to the 20-period moving average, there's a good chance we're going to sell maybe the 32 puts, maybe the 32.5 puts, we haven't picked that out, and take some money in. So we'll be able to do that. Okay, let's see. Do we have any more stocks? MDT, I think we got that. Any more stock symbols? I'm looking. If anyone would like to take one more stock, I'll have time for that, and then we can go into wrap-up. Okay, Greg, looking at Potash, POT. Potash is out of Canada, and this is a stock. This is a very interesting stock, because years ago I would trade this, and I have to say I don't think there was any time that I traded it where I lost money. I think there was 100% success in potash. And the reason for that is that it's a very technical stock. It trades very much in line with the technical signals. And if I go back and I look at this one right here, you could see that here is a level of support that was broken. And what happens when the support is broken? It turns into resistance. So this is role reversal resistance right here. You could see, again, on the weekly chart, that last week we had a bearish engulfing pattern. See this? Now, bearish engulfing patterns should not be ignored, especially if they're on the weekly chart. They're very, very reliable. There's an 80% chance potash is going to drop longer term. But in the meantime, there's also, interestingly enough, a role reversal support that the stock is right at. So we could see a short-term bounce on this one before it goes lower. And so it could be a very confusing stock. Now, last week, we put out a contingent alert on this one. And I said that if it closes below the 20-period moving average, you have to wait for the stock to hit the secondary support level before getting into it. So the equity traders are now looking for a bounce off of this key support level. All right? So that's the plan. Once that gets to this level right here, we then have an exit strategy up around 1834. So this could be $1 profit on a $17.50 stock, which isn't so bad short term. Now, if you pulled the trigger a little bit too early on that one, then what I would say is take some of the buying power that you have, and if it bounces off of here, you can buy again to lower your cost basis right to the middle, and then you'll be able to get out at the target and still be able to make money. So if you took one position, you've exposed yourself to 1% risk. Take a second position in the same stock, you're treating that as another position, even though it's the same symbol, you're treating that as a secondary position, also exposing yourself to 1%. So if you're trading potash and you buy some at a higher level, buy some at a lower level, the most you should lose is 2%, again, if you're following the rules for the 1% rule. And that, again, goes right back to this video right here that's on our Market Guy website. So, boy, that was, I think I lost 700 calories doing that presentation right there. So, by the way, I don't do these sitting down. I am standing up. I get some adrenaline pumping going there, and hopefully you're getting a lot out of this presentation. Now, as we come in to the new year, I just want to add this one final comment. When you come into the new year, we could very well see a January effect that will include selling pressure into the large cap stocks. What usually happens during January, February, and even March is the large cap stocks get hit as the money managers move money out of large cap stocks and they start to buy into small cap stocks. So our buy opportunities, if we're following this cycle, is not going to be in the Dow or in the Russell 2000. Any buy opportunities will most likely be coming from the NASDAQ market. So keep an eye on those alerts as we search for entry points. And at the same time, we're going to be hedging ourselves using some of the contra ETFs, the bearish ETFs. A hedge, by the way, is where you're trying to mitigate the downside exposure. We don't always make money on hedges. It's kind of like if you're buying an insurance policy on your car, you don't expect to make money on the policy. You're just using it to help pay for any damage that you might incur if you hit a telephone pole or something like that. So the money that you're spending towards insurance is money spent, and that gets calculated into the total cost of carrying a position. So if we do any hedge positions, we're doing that to protect against a big downside slide in the market and offset any of the losses that we might incur from any long positions. So I talk a lot about that, and I'll continue to talk more about that in the alerts that follow. So again, have a great evening. Thanks for joining us, and we'll talk to you soon. So long.
For almost 3 decades, A.J. Monty has motivated audiences worldwide about creating personal wealth and winning in business. His time-tested risk management strategies focus on ideas that involve a keep it super simple approach, also known as the KISS principle. These concepts have been delivered to people in over 16 countries around the world, reaching audiences in the millions. AJ is a best-selling author of 2 books, The Market Guy's 5 Points for Trading Success and Take Charge of Your Money Now, both of which have been featured on PBS Television, Fox Business News, ABC TV, as well as Sirius Money Radio. As a financial educator and consultant, he has worked with some of the most recognized names in the financial industry. Companies like Bank of America, Charles Schwab, E-Trade Financial, Scotiabank, and TD Ameritrade's Thinkorswim. If you have ever been challenged with having to make a tough decision regarding when to buy or sell a stock, then help is on the way. The Options Oracle and Equity Oracle Alert services are designed to help you make those tough decisions. AJ will not only help you find the best trade candidates, but he will also lay out the exit strategy for each position in an easy-to-understand format that anyone can follow.
Hi, my name is AJ Monty, Chief Market Strategist for The Market Guys. For almost 30 years, I've traded stocks, options, futures, and even currencies. I've traveled the world teaching people just like you how to profit in the market using time-tested strategies that focus on risk management. You see, the secret to making money in the market depends on your ability to limit losses when you're wrong. In other words, if you want to make a lot of money in the market, don't lose a lot of money in the market. Now that may sound funny, but it's true. Most investors are challenged with 2 questions. The first question is, how do you find a good stock? Well, the best way to find the right stock starts with eliminating all of the stocks you would not invest in. This process of elimination is called stock screening. And our services help you overcome the odds so you're putting your money where the money is going. We're simply following the trends. The second question most people ask of me is, when is it time to sell? Well, if you don't have an answer to this question, then you might find yourself in a position where you're holding on to your stocks when things go against you. This is the worst thing you could possibly do because I believe this is no longer a buy and hold market. It has evolved into a buy and protect market. Holding on and hoping for things to get better is not a strategy. In fact, doing this will eventually lead you to a catastrophic loss, and you wouldn't want that. Our Trade Alert services help answer these 2 questions. Not only will I help you find the right trade candidate, but I'll also show you how to use the charts to manage risk. I don't use the charts to predict the future. I use them to protect the future. The charts tell me when it's time to get out as well as when it's time to get in. And that's what I'd like to teach you as well. We have 2 services, the Equity Oracle and the Options Oracle. The Equity Oracle is an alert service for traders who would like to trade only equities, whereas the Options Oracle is our premier alert service for both equity and option traders. Each alert is laid out in an easy-to-understand format that shows charts depicting entry and exit points. Risk management is our cornerstone of each service, so you don't have to struggle with the decision of when to get out or when a trade goes against you, when should I take my loss. The strategy is to use the KISS principle, keeping it super simple. As a bonus, you'll have access to a live Q&A session as well, each and every month. This is where you can submit a stock symbol, and I will analyze these stocks while we discuss the best trading strategies for each position. And it gets better. In addition to the alert service and the live monthly Q&A sessions, we're also developing a member page that will include instructional videos about how to get the most out of our service. Without question, this is the best trade alert service available on the market, and we look forward to having you as our newest subscriber. Simply click on the link below to subscribe. It's easy. Once again, I'm AJ Monty, Chief Market Strategist for The Market Guys. Thanks for watching.
Enrolling in this service is easy. Simply click on the link below to subscribe, and your weekly alert will be delivered right to your email box. And if you act now, we will include AJ's best-selling book, The Market Guy's 5 Points for Trading Success. This is a first-time offer that will get you on the road to success and keep you there. Remember, if you continue to do what you've always done, things will never change. positive results will only come after you have taken the first step in the right direction. We look forward to having you as our newest member.